We're back again, chapter number 2, Analyzing and Recording Transactions. This is an overview of the objectives. The first objective is that you know and understand the 5 types of accounts. We've already talked briefly about these. The first type of account would be assets. Second type of account would be liabilities. The third is the equity category, and there are 2 accounts in equity. Those 2 accounts happen to be the capital account and the withdrawal account. The 4th category are revenues, and the 5th category are expenses. So anytime you look at a transaction of a business, you have to ask yourself, does this transaction impact assets? Does it impact liabilities? Does it impact the owner's equity, capital, or withdrawals? Does it impact the revenue, or does it impact an expense? Now, in this chapter, we have introduced a couple new asset accounts and a couple new liability accounts. I need you to know these new accounts. In the asset category, we are introduced to something called an account receivable. Now, in the note, in the handout that I've given you, I've indicated that students have difficulty with accounts receivable. A lot of students want to categorize an account receivable as a revenue. It is not. Accounts receivable is an asset. So when you see the word account receivable, please understand and please know that it is an asset. It was generated from a revenue activity, but the account receivable itself is an asset. Businesses often take this right to payment, which is an account receivable, and they might sell it or factor it, that's selling it, to a bank or somebody else. Now, the second type of asset that we have yet to be exposed to, and I need you to know this, is a prepaid account, often referred to as a prepaid asset or prepaid expense. What this is, and let me give you an example. If you're a baseball fan or a football fan and you have season tickets, you know that you have to pay for those season tickets 6 to 8 months in advance. That to you is a prepaid. It's an asset. If the Mariners or the Seahawks do not play those games, they have to refund you that money. So a prepaid expense is an asset. And in a business, examples would be they might prepay their rent, they might prepay their insurance, they might prepay their legal fees. And when they prepay that, that is an asset on the books of that entity. Liabilities, the new type of liability that you've yet to have, is something called unearned revenue. And what that is let's say you're an attorney, and before you do any services for a client, you say to the client, I would like you to pay me in advance. Well, if the attorney doesn't render the services, they have to give back the money. Therefore, that happens to be an unearned revenue. Unearned revenue is a liability on the books of the recipient, the attorney in our case. Now, again, let's go back to our season tickets. Let's say the business has tickets with the Mariners or the Seahawks, and they prepay those 6 to 8 months in advance. That's a prepaid asset. But to the Mariners or to the Seahawks, they've received money before the games have been played. That is an unearned revenue on their books. So I need you to know that the prepaid expense or asset on one company's books is the unearned revenue or liability on the person that they paid it to. I need you to know that under equity there are 2 types of accounts, the capital account and the withdrawal account. And I need you to know that withdrawals of the owner are not an expense. Since they're not an expense, those withdrawals do not go on the income statement. They go on the statement of owner's equity, just as the capital goes on the statement of owner's equity. And you need to know that there are revenue accounts. Those are inflows. Revenues are sometimes called sales, sometimes called income. sometimes called earned income. And then there are the expenses. So you need to know, first objective is there are 5 categories of accounts. You need to know what the 5 categories are: assets, liabilities, equity, revenues, and expenses. The second objective that we have in this chapter is you need to know the double entry accounting system. Now, in the example we did in chapter 1, we had an opportunity to kind of briefly discuss the double entry system of accounting. But it is discussed here in depth in chapter number 2. And what I need you to know is that every transaction, there are at least 2 parts to the transaction. Sometimes there could be 3 or 4, but there are at least 2. Let me give you an example. The owner invests cash into the business. Part of the transaction on the business books is the cash. The other part of the transaction is the capital account. The cash goes up because the owner put money or cash into the business, and the owner's equity or capital goes up because they now have an interest in that business. So the double entry system of accounting says there are at least 2 parts. In addition to the double entry system, we have 2 new terms. One is called a debit and one is called a credit. Now, often students come into this class and they think that debits mean good or credits are bad, or debits are pluses, additions, or credits are deductions, or vice versa. Debits and credits by themselves do not mean good, they do not mean bad. They do not mean plus, they do not mean minus. Debit and credit onto themselves mean left or right. And which is which? The debit is left, the credit is right. Example, if you're going home and driving, you're giving somebody directions, you come up to a stop sign and you want them to turn left, you could say, instead of take a left here, you could say take a debit, because debit means left. Or conversely, if you want the person to turn to the right, you say take a credit, because credit means right. So debit and credit mean left and right. Now the reason I bring it up here is because in a double entry system of accounting, you have at least 2 parts. And the parts that you have are going to be debit parts and credit parts. And every transaction, the debit parts of the transaction must equal the credit parts of the transaction. And here in a few minutes, when we get to the idea of journalizing, you will find out that when we journalize every journal entry, the debits of that entry have to equal the credits to that entry. Now, debit and credit do in fact take on pluses and minuses when we refer to assets, liabilities, equity, revenue, and expenses. So the next objective in this chapter are knowing how debits and credits impact our 5 categories of accounts. And in fact, right here on the board, what I happen to have are what we call T accounts. Now, T accounts are used for us to demonstrate categories of accounts. And we happen to have assets, and you'll notice on the left side of that T is a DR. That stands for debits. And on the right side of that asset is CR. That stands for credit. Now, I know credits, the CR is a logical explanation, but debit and an explanation of DR, well, apparently in your textbook indicates that comes from debitor, and that's why it is DR. You need to memorize the debits are increased by debits, assets are increased by debits, and they are decreased by credits. And then you need to know that liabilities are decreased with debits and increased by credits. Now, in owner's equity, again, we have 2 types of accounts, capital and withdrawal. So you can see here on the board, capital is decreased by a debit and increased by a credit. However, withdrawals are just the opposite. And that makes sense because withdrawals are the money or the funds or the assets that the owner is taking out of the business. If they're taking things out, withdrawals will be increased by debits and they will be decreased by credits. And the last two categories are revenues and expenses. Revenues are increased, as you can see, with a credit and decreased by a debit. Expenses are the opposite. Expenses are increased by debits and decreased by credits. So you need to know this particular sequence right here. The night before the first exam, because you're going to be doing a bunch of debiting and crediting and journal entries, I would hope that you would dream about this. You need to memorize this. You need to know this. This is the fundamental aspect of the double entry system of accounting. Now, the next objective is the accounting cycle. And as we move across the board here, we will see that we have some terms that you've yet to be exposed to. Some of those terms are journal, ledger, trial balance. In Chapter 2, we will be looking at the journal, we will be looking at the ledger, and we will be looking at the trial balance. What we will be doing is all of the transactions that we will have will go into the journal, and we will learn how to journalize. We will then take that information and we will move it from the journal to the ledger. That moving of information from the journal to the ledger is called posting. And I will ask you to post the journal entries to the ledger. We will then look at the ledger balances, and each account has its own ledger balance, and we will prepare what is called a trial balance. The trial balance is all of the balances of the accounts in the ledger. And the debits must equal the credits in the balances. This we will do in chapter number 2. In chapter number 3, we will continue to move, and we will move down to something called adjusting journal entries. These entries, again, are in the journal. And anytime you put something in the journal, it must be then transferred from the journal to the ledger. And we all know that when you transfer from the journal to the ledger, that's called posting. We then, after we put something in the ledger, we need to prepare a trial balance. But this time, the trial balance is an adjusted trial balance because it is after we've made the adjustments to the ledger accounts. And again, the debits must equal the credits. After the accounts have been adjusted to their proper balance, we will prepare financial statements. Our financial statements will be our income statement, our statement of changes in owner's equity, our balance sheet, and eventually we will prepare a statement of cash flow. That will be in Accnt202. But we will do this, the balance sheet, the income statement, and statement of own equity in this course. After we prepare our financial statements, we will prepare what are called closing journal entries. These closing entries will close out something we call temporary accounts. And we will talk about that in chapter number 4. Anytime you put something in the journal, what do? You move that information to the ledger. That moving the information from the journal to the ledger is called posting. And after any time you put something to the ledger, you want to make sure the debits equal the credits. So you prepare a trial balance. And the last trial balance is something called the post-closing trial balance. This is the accounting cycle. Think of it like a wheel. You start in one place, you go all the way around the wheel, and you end up where you started from. And what we would do is after this post-closing trial balance, we would start the next period with transactions, and we would go through this whole thing again. So that is the last objective in this particular chapter. So the objectives in this chapter are knowing the 5 categories of accounts: assets, liabilities, equity, revenues and expenses, understanding the double entry system of accounting, understanding the accounting cycle, and understanding the idea of debits and credits, and we will prepare a variety of journal entries.